Good afternoon for everybody. I'm glad to see all of you here on Investment Academy. So, throughout of these 4 webinars, we will examine a lot of questions that can directly touch investors or even traders. And of course, the main question is to examine how to survive in quite volatile market environment, how you can elaborate your own financial plan, and how to control your risks while hunting for profits. I'll show you visual representation, so in such a way this information will be more convenient. So let's start. And our first theme is the investors among the global financial system. And is it real to be a profitable little fish in the financial ocean with big professional sharks? Okay, let's start with the real economy and stock markets. Is it simply supply and demand curve as it studied in school or even in university for real goods? Or is it something more in financial markets? If we convert demand and supply curves into the market, expectation must rise with rising of real numbers in GDP. So then followed by estimates of higher real economy returns in dividend. It's understand that lower numbers in GDP does mean that we will receive worse quarterly industries reports and worse dividend returns. Maybe it must be like that in ideal world. Let's show next picture. Look at this picture with index S&P 500 chart. Here we see growing volume. So its mean quantity of contract change that more higher than in previous periods. And high interest to buy stock from 1080. But we see also falling GDP from 2015. And we see new high by S&P 500 chart. Is it real economy and real expectations? I'm sure that this is expectation and hope to catch the boom with cheap money. So can we believe looking at this chart in strong financial numbers, good reports from business? But let's recall events from 1929. This is Dow Jones chart 1929, 1928. What happened at that time? Good expectations, numbers, and all seems good at that time. But suddenly big drop on stock market. After it, followed bad reports from industries and finally Great Depression until 1950. Maybe we're a little bit clever now after such big crisis. Maybe, but I'm not sure. I think that after rejection from gold standard in 1971 by Nixon, the financial world and financial engineering has uh, learned well how to build big bubbles even better than it was in 1929. And as a result, we can remember dot-com crisis in 2000, mortgage crisis in 2008, and it's only America crisis. And with unsolved structural problems and big rejections, that can be only the beginning of new Great Depression. So, what is a real economy? And why it's so important to understand it? Can we know just at time any preconditions of oncoming crisis? It's difficult and even nearly useless because except of number in economy, the most important role play public psychology, emotions, fear and greed. And it's a big risk for stock when public and investors are in doubt. In real life, we see a lot of stimulus measures to support bubbles and government trying to convince public. So that it's all okay. And let's make money together. And you know, it doesn't matter which way we choose, but we are always investors. For example, if we save in cash, we are very passive investors without any returns, and only what we can do are believing in the strength of currency that anyway will inflate with the government printing money. If we will invest into banking deposits, we will have a little return, but even not enough to fulfill inflation. And point three. So, only way to exceed inflation and to make additional profits is to invest into financial markets, but you need to understand that it's connected with high risks, and you must know how, when, and what to do. You need to know principles of diversification and how to control your risks. Uh, Now I'll give you an example of existing problem with the global debt. It's a very important theme, and it's a common theme of big number of crises. Of course, huge injections into the economy can burst in short-term period economic numbers and make big illusion of non-stop growth. This short-term effect allows for the ruling party seems to be more effective than it actually is, but it's very difficult to support bubble economic numbers. So, it's often monetary and fiscal measures directed to create the illusion, the effectiveness of ruling party. And let's look at this picture. We don't know where and how, but for ruling party, it's always more simple to blow up the bubble and to accuse of inefficiency previous government. We see after rising, drawdown, and big potential for the second term of George W. Bush. Then rising, and before Barack Obama came, once again, drawdown, and big potential for first and second term. Now what will happen with Donald Trump will come? Who knows? But actually it will be more simple and more convenient to begin such it was earlier. Okay, but let's be realistic. Let's look at this joking picture. This picture reflected good all our financial life and financial relationships. So in real life, the private sector can borrow cheap money for consumption and to boost prices higher than it might to be in long-term perspectives. So banks in such a way seems more stable with big amounts of profits, but it's only for the short-term effect. In the long term, such large-scale debt can lead to high risks because they make the economy vulnerable to crises of confidence, particularly when debt is short-term and requires constant refinancing. So once again, such booms of economy fueled by debt, printing money, or record low interest rate often give false confirmation of government policy and the ability of financial institutions to create high profits, as they create the illusion of raising the standard of living. Most of the economic boom ends badly, and even worse when all monetary and fiscal instruments mostly have been used. Look at this picture. From 18 we see growing index, growing market. We see drawdown in 2000, 2002, and next drawdown in 2008 when mortgage crisis came. But pay attention at Federal Reserve percent interest rate. It was lower, 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 and lower. And now it's near record low. And one question: how to burst economy with falling GDP and record low interest rate? What kind of instruments they will be used, fiscal and monetary? It's a very important question, and I don't know. The next big drop can be very messy. Of course, debt instruments are important for all economies, ancient and modern. But the balance between risks and opportunities of debt is always a problem. This is a test which economists, politicians, investors, and ordinary citizens must never forget. Defaults followed by unbalanced economy, and debt happens when the government cannot ensure payment of their internal or external debt, or both at the same time. Moreover, there were banking crises that the financial world experienced in the early 21st century. During a typical large-scale banking crisis, the nation finds that a significant part of its banking sector became insolvent because of losses of investment. And look at this picture once again. When we stand here, we have a balance between risk and benefit. But here, with falling GDP and S&P in new high, I think that risks more higher than benefits. So another significant type of crisis of exchange rates. And such crises struck Asia, Europe, and Latin America in 19th of the last century. During a typical crisis of the exchange rate, value of the national currency of the country drops sharply, often despite the government's assurances that it will not allow that to happen under any circumstances. And in practice, such unexpected increase in inflation or devaluation is de facto equivalent of the full default. Thus, business begins to build debt pyramid. For example, imagine a lot of local enterprises took a loan in national currency, but demand shortened and business turned into losses. So business needs to cover their loans, and the government decided to support national economy and avoiding series of bankruptcy and to save their political image. Then banking system began to print money and even cut interest rate. Printing money leads to falling of local future injections help to take more loans and subsidies and to fulfill old loans and debt avoiding bankruptcy. So you must remember, sharp drop of currency rate or devaluation, it's equally of hidden default. Let's look at this joking picture. And as it looks like at this picture, in the modern era of sovereign debt crisis, big risks are concentrated mostly in emerging markets, connecting with fears and investors' confidence. Of course, the developed and strong economy examined by time and settle more confidence for investors. But contrary, emerging markets with first signs of problems in economy can lead to outflow of investors because of wishes to fix current profits and of course avoiding losses of capital in fear that the economy will declare default. So I can say that confidence in strength of economy is a long-term process of economic, financial, social, and political development that can take centuries. Look in history, and for example, at an early stage of its development, France fell into a situation of default of its foreign debt more than 8 times. Spain 6 times before 18th century, but also announced 7 defaults in 19th century. From 18th century until the end of World War II, Greece excited in cases of permanent default. And default also occurred in Portugal, Prussia, Italy. Countries such as Egypt, Turkey, and Russia were also in situations of chronic default. Nowadays, only Australia, New Zealand, Canada, Denmark, Thailand, and the United States avoided defaults. Also, if you look at the US foreign debt today, it already accounts a record $19 trillion, including the expense of guaranteed mortgage loans. And this is unsolved continuation of 2008 crisis, simply postponed by printing money, adopted by the Federal Reserve Fund with a full guarantee of the withdrawal of bad assets from the balance sheet of bank documents. And everybody understands that big crisis in USA will reflect it globally and will lead into great economic depression. So the central banks and leading governments try not to pay a lot of attention of these problems and simply trying to support short-term political image. If we take the modern global banking structure as a whole and believe in insurance of the largest banks, insurance companies, or help from IMF, we need to understand that neither who involved in a liquidity crisis cannot afford to cope with a global drawdown when financial world will come into lack of confidence in the banking system. The problem is that if someone provides insurance of all and all without conditions, some players will start to behave badly. If the IMF gives loans too much on soft conditions, so then IMF itself would be bankrupt in the very near term, and no one will control global economic situation. So, full insurance against crisis is not possible, not desirable. So, when thinking about safety of your capital, you need to firstly think about your risk tolerance. And never believe in optimistic newsline, because even rapidly growing numbers and strong economy can transform surprisingly into losses of your investments. For example, Asia in 19 and Newsline optimistically demonstrated every day before crisis such words. Households have an extremely high level of savings and government could rely in the event of financial stress. The government had a relatively strong financial positions and the majority of loans are private. Currency has linkage to the USA dollar, which makes the investment safe. We believe that the Asian countries can be in financial crisis, and such words we heard every day from solid analytics on TV, news, and financial blogs, as it was in the distant 1929. But we remember what happened in 1929 with big financial crash in USA, and we remember Asian market collapse which happened in summer 1997 all over Asia. Thailand, Korea, Indonesia, all of these countries were in need to ask help from IMF for the huge amount of injections. And even it was not enough. Finally, Great Depression came and huge devaluation of nation currencies appeared. Look at this chart. Japanese index Nikkei, and till now can beat their highs showed in 90. Next example is Latin America of 19. In this case, the region overcame from a series of crises, once again began to attract the attention of investors after transition from dictatorship into democracy. So, business world expecting strengthening of the economic situation and political big growth. Finally, lending boom of the 19th ended with a series of financial crises, which started in Mexico in December 1994, followed by Argentina default with $95 billion, followed by Brazil in 1998, and default in Uruguay in 2002. Intolerance to debt defined as a relation to levels of external debt which looks quite manageable by the standards of developed countries. Ultimately, the default is often happened when the ratio of debt to GDP is significantly below 60%. And this limitation typically leads to losses of confidence, spiral movement in raising interest on the external debt, and finally crisis will come. So, look at the numbers in example. Of course, the debt in Japan with 255% and maybe more doesn't mean immediate default, because developed countries with strong economy have a massive foreign exchange resources. But, however, it's huge risks that can end with confidence crisis, which happened with Japan in 19. For emerging markets, these numbers might be less even than 60%. For example, default in Mexico happened with debt-GDP ratio 50%, Ecuador in 2008 with 68, Russia in 1998 with 58. So the average debt-GDP ratio is approximately 69%. Finally, speaking of the foreign debt, it should be understood that the country can maintain a high internal debt if there are real sources of income to pay interest, and for this might to be a significant inflow to the balance from exports and its tendency to increase. However, you must always remember that crises and defaults it's like repeating patterns during the past centuries. And here at this example, this picture, you see a big history of percentage of countries in default, growing forward, growing forward. So crisis is a normal pattern. The default is usually connected with high inflation values. If we take the interval from the past centuries, the average inflation rate in the year of default reached 33% per year. But real and dramatic rise in inflation starts when crisis on domestic debt is begin, with an average of 177% in the year of default. After the default of domestic debt, inflation remains at the level of 100 or higher in the following next years. Sometimes, for political reasons, the default cannot be declared. Then in replacing the default comes devaluation, which in its essence is a kind of default, because most of the national currency is now assured. In other words, paper money is a currency that often hasn't any value and used by the population for the most part because the government declared that no other currency can be used for transactions. So, I hope you understand the main idea of this webinar. We don't know exactly what it will be in the future. We are not insider, we are not predictor, and nobody knows what will happen next. But can we survive and can we be profitable as a little fish in financial ocean with big professional sharks and such unpredictable and volatile market conditions? Yes, we can. But only few effective things we can to do, and they are controlling our risk through clever diversification, choose best timing for our investments, and to build competent and efficient financial plans with aims, expectations, and risks. But this theme we will detail analyze in the next webinars. I wish you a good day. Thank you for attention and see you.